Finishing up our discussion of life insurance, we talked about term insurance, which only lasts for a certain term and only covers the death benefit. Well, you can imagine if someone has been paying this $880 a year for 10 years, and they look back and say, you know, I've spent almost $9,000 and I don't have anything to show for it. Well, the life insurance company would say, well, yes, you do have something to show for it, because for the past 10 years you've had the peace of mind of knowing that if you had died, your family would have been taken care of in that amount. Well, you can imagine if enough people start saying, I don't have anything to show for this, the life insurance company says, we need to come up with some other products that build cash value. In other words, they're more of an investment. This is simply a 1 year or a 5-year bet on my death. Okay? So there are different kinds of policies, and you can see on our table on 473, there is straight life, and on the next page there's a description of straight life. It is on page 474. Sometimes it's called ordinary life. Straight life provides permanent protection rather than temporary protection provided by term insurance. The insured pays the same premium each year or until death. In other words, I'm going to pay a higher premium, and I'm going to pay it every year until I die. And when I die, my beneficiary will get that face amount. But if at any point before I die I say, you know, I'm tired of paying this, what can I do? Well, I've got some choices. There's a cash value associated with that policy. I can turn it in, they give me the cash, I don't have any more insurance, and I'm done paying the premium, and I've got some cash for it. Or I can say, you keep the cash and give me a higher face value for a certain length of time. Or you can say, give me the cash, or keep the cash and reduce this amount for paid up insurance. So let's just talk in general terms. Straight life is the most simple kind of permanent protection, as the insurance company would say. Then the next one is 20 payment life, and it's much more expensive, but you only pay it for 20 years and then you're paid up. And if you decide to leave it there, your beneficiary will get that amount whenever you die, and you're already done paying for it. All right? Or you can take cash value. So there's 20 payment life. Then there's 20-year endowment life, and that's the most expensive of the ones we discuss. But there's all sorts of benefits to that. Check this out. 20-year endowment, at the bottom of page 474, it says, it's the most expensive. It's a combination of term insurance and cash value. For example, from age 40 to 60, you receive that term insurance protection, in that your beneficiary would receive the $250,000 should you die. At age 60, your protection ends and you receive the face value of the policy. In other words, whether you live or whether you die, you get that $250,000. Now, how much does it cost to get that? Let's look at the numbers they give us here. They're using a face amount of $200,000, and they're using an annual premium of $66.72. $66.72 a year. So let's multiply that by 20 and see how much we would pay for this over the course of 20 years. Does that look right? $133,000? Now, if we die any time in there, if we die in the first year, we only pay this much and our beneficiary gets the whole amount. But if we pay for 20 years, then they hand us a check for $200,000 at the end of that 20 years. Okay? So, now, is it a good deal to do that? It really depends on your personality. If you're a person who does not do well with savings, In other words, we talked about mortgages where you can always pay more on your mortgage and pay it off faster, but most people don't have the discipline to do that. So that's why we say it's better to get a short-term loan than a long-term, because it forces you to pay it off sooner. Now, a similar situation is in play here. If I'm a person who does not do well at savings, then I might want to do one of these permanent protection kind of policies that builds up cash value, because it's forcing me to pay extra. But here's what's really happening. The life insurance company really has only one product to sell, and that's the death benefit. That's all they can sell. That's all they have to offer, is that death benefit. So here's what happens in permanent insurance. If this is age 40, and this is age 50, and this is age 60, when I'm 40, I'm much less likely to die. Okay, here's our, let's say, $800 a year mark. That's how much it's costing them to insure my death when I'm 40. But how much am I paying them? Actually, in the book, I think it was $704. How much am I paying them? I'm paying them $6,000, almost $6,000 more that first year. So I'm paying them this much. Okay? Now, as time goes on, the cost of insuring my death is going up because I'm getting older, I'm more likely to die. And so it's a curve that looks something like this. I'm paying this constant amount. And here's what the life insurance company is doing. It probably actually crosses at some point before I'm 60. In other words, there's some point there before I'm 60 where it's actually costing the life insurance company more to insure my death than I'm paying them that year. But every year they're taking this difference and they're investing it in mutual funds and stocks and bonds or whatever, and they're giving me a part of that in this $66,560 that I'm earning over 20 years. Now, if we figured that out compound interest-wise, that might be about 1 or 2%. I'm just guessing. Over 20 years, you know, that's not a whole lot of interest. But what the company does is they say, we'll take that difference every year and we'll invest it, and we're betting that whenever you die, and we have to pay, obviously if you die in here, we lose money. But if you go 20 years and don't die, we're betting that we're going to make enough money with all that extra you gave us to invest that we're still going to come out ahead. So most financial planners tell people, if you're a disciplined saver, you can probably do better by taking that difference yourself and investing it in a mutual fund or the stock market or whatever. So in other words, if I could afford to spend $6,700 a year, I'd be better off spending $700 for term insurance and taking the other $6,000 and putting it in an investment somewhere than I would be giving it to a middleman, the life insurance company, to invest it for me. Okay? So, now, if you, does anyone work for, or have you ever worked for an employer who matches a contribution to a 401k or something like that? Okay, if you work for an employer who matches your contributions to a retirement fund, then this is definitely, almost positively more effective for you to invest that extra money yourself. In other words, if some companies, if I invest $1, they'll add 50 cents for every dollar I invest up to a certain percentage of my salary. Some will match dollar for dollar, some will match more than what I put in. Well, if somebody's going to, if I can take $6,000 and get another $6,000 given to me by my company and put $12,000 in retirement that year, that's way better than giving $6,000 of it to the life insurance company. Okay. Now again, I've got a lot of friends in the life insurance business. I have nothing against life insurance companies, but they will tell you. I have a friend who was our insurance agent for years, and we'd get together every 3 or 4 years, and he'd say, you know, I notice you've still got temporary insurance. Maybe we ought to get you some permanent protection. That's the terms they use. Term insurance is called temporary, and these others that have a cash value are called permanent protection. And then I tell him, well, you know, Phil, you told me last time we talked that if I had an employer that matched me, it was better for me. And he just, you know, oh, done deal. No argument there. Yeah, I forgot you had that situation. Yeah, you're way better off doing that. Okay, so it just depends on your situation.